Welcome back to the channel, everyone. Today I want to talk about how BlackRock recently fired some whistleblowers and why this may be the reason why we haven't yet seen any Citadel whistleblowers, because they know they're just going to get fired and the SEC aren't going to take their complaints seriously. So stay tuned and let's make some money. Now, I'm sure you've probably already noticed that my face is looking a little bit more red than usual, especially around my nose. I've already picked up some sunburn and I'm sure it's going to get worse as the week progresses. But now I want to dive straight in with the key information. So, Rizzo tweeted saying BlackRock fired 3 senior asset managers who were attempting to coordinate their exit and join Apollo Asset Management. He said, "Something tells me there's more than meets the eye here, and record inflation and the Fed winding down quantitative easing and the raising of interest rates means there's no more cheap money." Now, I may not have worked in the investment industry, but I have worked in the accounting industry for many years. During my years working in the industry, I didn't ever see anyone being fired just for wanting to move to a different firm. Typically, many firms are very supportive of a move because obviously it means that that firm doesn't have to pay the salary any longer and also doesn't have to pay any termination fees or any early buyout clauses either. The new firm picks up all of these fees and takes on the employee and continues to pay their salary. Therefore, typically, firms don't go around firing people for no reason, especially when they're planning to move to a new company. And therefore, as Rizzo says, it seems that there's something more than what meets the eye. So the article says that BlackRock dismisses 3 managing directors for engaging in a coordinated effort to quit. The trio will still join Apollo Global Management as it looks to expand its secondary solution business. Now, this just means that BlackRock lost some employees and also had to pay all of those termination fees and still get rid of those employees. It says BlackRock made the decision to terminate all 3 employees after learning of their intention to depart the firm in a coordinated fashion. Now, you may say, "Tom, surely BlackRock wouldn't just fire those whistleblowers because you're not really allowed to fire whistleblowers and you're not really supposed to either, right?" But interestingly enough, back in 2017, so a fair few years ago, BlackRock settled some US SEC charges over whistleblower protection violations. So therefore, BlackRock has already previously fired whistleblowers, and therefore it wouldn't surprise me if they did it again, especially with the absolutely minuscule fee that they received. It says asset manager BlackRock will pay a $340,000 penalty to settle charges that it improperly required parting employees to sign agreements that force them to waive their rights to recover whistleblower awards. So basically, BlackRock can fire any whistleblower that they choose, and all they had to do was pay a $340,000 fee, which is obviously absolutely minuscule compared to the millions and billions of dollars that have been gained in illegal crimes. It says in settling the case, BlackRock becomes the largest in a growing list of companies that have been accused by the SEC of stifling participation in the agency's whistleblower program. And obviously, as usual, BlackRock settled the case without admitting or denying the charges. They just simply paid the $340,000 fee. Therefore, they knew they were guilty, but instead of admitting they were guilty, they just jumped right to the end and paid that fee. And therefore, I personally believe that this may be the reason why we haven't yet seen any Citadel whistleblowers as a result of the AMC and GameStop fiasco. Obviously, we've been waiting for months and months and months now for that Citadel whistleblower to pop out of the woodwork and admit to all of the crimes currently being performed. I think that these Citadel employees have either A, something written into their contract that prevents them from blowing the whistle, or they know that as soon as they blow the whistle, Citadel are just going to fire them. And they most probably also know that obviously the SEC are currently in bed with Citadel, and they know that the SEC either wouldn't take the complaint seriously or would do the typical SEC thing and ignore the wrongdoing. That way, the Citadel employee that blew the whistle would end up being fired and they'd struggle to ever get a job in the investment industry ever again, and nothing would ever come of it because the SEC would just simply ignore the report. You may say, "Tom, the SEC can't just ignore whistleblower reports because the SEC have to do their job and they have to prosecute any such criminal wrongdoing." But again, I'd simply say to look at the impact that the SEC have had on the AMC and GameStop stock and all of these illegal activities that are currently ongoing right now in plain sight. Absolutely nothing. Guys, if you didn't already know, Moomoo have recently increased their offering of free shares up to 6 free shares valued up to $3,500 each, which is a total of up to $21,000 in free stocks just for signing up with Moomoo using the link in the description below and making your first deposit. Moomoo and Futu have also just officially announced that Futu does not accept payment for order flow, and therefore you don't have to worry about your trades going through sketchy dark pools or being given to Citadel. Moomoo also recently won the award for being the best trading platform at the FinTech Breakthrough Awards. Moomoo is incredibly easy to use, it's very customizable, and it will help you to trade like a pro. Moomoo also has tons of technical indicators and advanced charting tools. Moomoo publishes daily short selling data, position cost distribution, and much more. So guys, be sure to sign up to Moomoo using the link in the description below to get up to $21,000 in free stocks, because at the end of the day, everybody loves free money. And it seems the SEC is getting even more corrupt and has even been blackmailing people like Elon Musk and Tesla. A quote from Elon Musk says that I was told by the banks that if I did not agree to settle with the SEC, then they would cease to provide working capital and Tesla would go bankrupt immediately. And he said, so I was forced to concede to the SEC unlawfully and admit the wrongdoing and pay those SEC fines. He said I was forced to admit that I lied to save Tesla's life. And this goes to show just how in bed the SEC are with these large banks and institutions, threatening to withdraw funding just until Elon Musk admits his wrongdoing and concedes to the SEC. This was all obviously so the SEC could just make a point in the public eye and show that not even Elon Musk can escape with wrongdoing. But yet they completely ignore everything that isn't necessarily in the public eye and what goes on behind closed doors, just like how Citadel and many other market makers intentionally manipulate the market. And interestingly enough, on that note of Elon Musk and Tesla, and now Twitter as well, Twitter have decided that the shareholders should not be making the decision as to whether Elon Musk can purchase the whole of Twitter. Brandon Moore said so Twitter's board didn't allow the shareholders to vote on Elon Musk buying the company, choosing instead to tank its own stock price with a poison pill. He said they really don't want people to speak freely. So this poison pill is used to make a proposed acquisition less appealing for the acquirer. The tactic comes in two forms called the flip-in and flip-over strategies. It says the flip-in strategy allows current shareholders, except for the acquirer, to purchase additional shares at a discount. It said this results in immediate profits for shareholders and a diluted ownership stake for the acquirer, making the deal less appealing. A flip-over strategy, on the other hand, lets shareholders of the target company purchase shares of the acquiring company at a discount if the takeover is successful. This, in turn, dilutes the equity in the acquiring company and again makes the deal less appealing for the company, threatening a hostile takeover. It basically means that any current Twitter shareholder can purchase new shares of Twitter at a discount, which dilutes the current shareholding massively and obviously makes the overall deal less appealing to Elon Musk. At the same time, it obviously damages and potentially destroys Twitter as a company and massively drops its market capitalization and its share price as well. So Twitter is quite literally shooting itself in its own foot just to prevent Elon Musk taking over the company and promoting free speech. And as Cernovich tweeted saying, Twitter won't even let its shareholders vote. Imagine what they're doing to our current elections. We know that there's tons and tons of censorship on Twitter, and we know that they've also been embroiled on the election rigging lawsuits and could potentially be helping to rig those elections. And now that wouldn't surprise me, especially as they aren't even letting their own shareholders vote for a takeover, which promotes fair speech. And as Laidback says, Twitter would rather see the stock go to $10 per share than let Elon Musk take control of the company. He said that should tell you everything you need to know about what Twitter really cares about, what their agenda is, and what their purpose is. I personally think that Twitter's plan is to continue their censorship and not allow those to speak freely on the social media platform. Obviously, Elon Musk has said that he does have a plan B to take control of Twitter and to continue promoting free speech, which I guess we'll see over the coming days and the coming few weeks. And now the GameStop dividend could also force many share lenders like Blackrock and Vanguard to recall their lent out GameStop shares, which could potentially trigger the short squeeze. It says lenders must call back their lent out shares to take advantage of DRD, which is dividends received deduction, a tax advantage when corporations offer a stock dividend, aka only a qualified dividend. None of this manufactured or substitute shares will fly for the tax arbitrage purposes. So it says the owner of a security can allow his or her security to be lent out for the likely purpose of the security being sold short, aka in the circumstance of Blackrock and Vanguard, who are lending out their shares for shorters to short. It says if a dividend is paid while the security is on loan, the lender of the security is entitled to receive a substitute or manufactured dividend paid by the borrowing broker and typically charged to the short seller. However, manufactured or substitute dividends are not considered qualified dividends and therefore are taxed at a less favourable rate. And therefore Blackrock and Vanguard would have to pay significantly more tax because they're having their shares lent out and they're receiving this manufactured or substituted dividend. And obviously that tax that Blackrock and Vanguard would have to pay wouldn't be at this 15% rate, it would be at a much higher rate, maybe 40 or 50%, which would vastly outweigh the money that Blackrock and Vanguard are gaining from lending out their shares, which is around 1% per year. And it says to take advantage of the DRD, corporate lenders need to either call back their shares or borrow shares themselves for the dividend record date. Basically meaning that Blackrock and Vanguard are likely to recall their lent out GameStop shares on the dividend date so that Blackrock and Vanguard can take tax advantages of those dividends received. And finally, I wanted to touch on the failing AMC short thesis, which has obviously not been doing too well, especially over the last year. So this yellow bar here was AMC's loss and the green bar was AMC's revenue. Obviously over the last year, this green bar has been steadily increasing as AMC has been generating more and more revenue, and obviously the yellow loss bar has been decreasing significantly as well. Right now, AMC are very close to turning a profit, and I do think that in the second quarter, AMC could become profitable and would also be allowed to pay dividends to the shareholders. Obviously, looking at this year-over-year change column here, we can see that all of AMC's figures across the board are up significantly from this time last year. Guys, be sure to let me know down in the comments below what you think about Blackrock firing these whistleblowers and whether you think this is why any Citadel whistleblowers haven't yet come forward. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.